Welcome to another episode of Mutual Growth, a podcast by Penn Community Bank. I'm your host, Aaron Clark. Today, we're once again joined by Dorothy Jaworski, Penn Community Bank Director of Treasury and Risk Management, to get her thoughts on the state of the economy and her forecast on what comes next. After the show is over, be sure to check out the show notes and links to resources at penncommunitybank.com/podcast.
Alrighty, Dorothy Jaworski, welcome back to the show.
Thanks, Aaron.
A lot to get to, as always, as we look at the quarter that was and the quarter that will become. So let's dive farther back than last quarter and just give us a recap of the beginning of the year, quarter one, quarter two. What have we seen now that we're halfway through 2023, believe it or not?
Yeah, I can't believe that we're halfway through already. And now it's summertime. But looking back, starting with the first quarter, interest rates are the primary thing that's been happening. The Federal Reserve continued raising rates early in the year. They raised rates 25 basis points in February, March, and May. And, that was 25 basis points each. And then they deviated starting in February from the large increases that they were doing last year. So it's an indication that they're getting closer to the end. In June, however, they chose not to change rates at all. So they didn't raise them at their meeting. They left them alone, but they did emphasize they could raise them later on in July or September. So, what we're looking at is short-term rates are now much higher than long-term rates. They continue to, raise the short-term rate, which they control. That whole situation is called an inverted yield curve, where, short rates are much higher. Short-term rates are up 500 basis points or 5%, and long-term rates are up 200 basis points. So long-term rates don't respond totally to the Fed. They have to look ahead at inflation, which, I'll get into that in a minute. That's falling. And they also have to look at the economic outlook. And, it is weakening. So, what I've seen happen in the first quarter is the economy is slowing. Manufacturing is down, confidence is down, both on the business side and the consumer side. Housing was really down early in the first quarter. Recently, that's had a little bit of a rebound. And mostly it was new home sales. And I believe that builders are providing incentives to clear out their inventory because they had way too much inventory. Business investment is down. I saw it in the GDP numbers, especially inventories, and the retail side is down more than, the wholesale side. So, the only part of the economy that's still chugging along, fairly strong is the consumer spending. That has been, mostly on services such as travel, entertainment, eating out at restaurants, things like that. So it's mostly consumers have shifted from piling on and buying goods, a couple of years ago to now, treating themselves to services. So they still have excess savings, probably left over from the pandemic stimulus, and they are using their credit cards. So that, that could be an impact later on when they realize, how big those balances are and how high those rates are. But GDP in the first quarter, it was just revised this morning, came in at 2%. And the fourth quarter, 0.6. The estimate for the quarter that we're in is 1.9%. And the Atlanta Fed provides that projection. So they're saying 1.9 right now. So we have slowed to about 2%. Stocks, however, they rallied pretty strongly year to date. There's been some volatility, but the S&P is up 14% so far this year. And NASDAQ is up 29%. And mostly NASDAQ is up a lot because of the latest investment craze, which is AI, generative AI, and things like the chat GPT. Everybody's talking about how they can incorporate that in their businesses. but you want to be cautious and slow because we don't fully understand exactly what that, software is going to do. So, who knows? And then, sadly, in the first quarter, we had a banking crisis. We had 3 large banks in the US fail, and then 1 European bank failed. So, what happened is, the FDIC took over and organized another bank to come in and acquire most of the assets and the deposits. So, it calmed the markets, temporarily. But, the failures were caused mainly by high interest rates and nervous large depositors, especially with the Silicon Valley Bank. That was the largest one to fail. It created, what's called a classic run on the bank. Up to 45% of their investors were demanding their money, to withdraw it on basically the same day. So, it was very hard for them to raise cash, to satisfy all of that.
Yeah, let's, staying on that topic there of SVB and some of the turmoil in the financial sector. I want to get your sense, both in your role in kind of looking at the impact to the sector from the economic side, but also from your role as the bank's, analyst and treasurer, to kind of understand what the reaction from that had been. Obviously right away there was a lot of concern, would it trickle, and particularly into a larger run on regional banks or maybe even smaller institutions. Kind of what was the takeaway from it in real time, and how did it impact your role with the bank and Penn Community Bank's operations?
Yeah, right away, we saw, the crisis unfolding. And then over the weekend, the FDIC took action, and, a second bank was taken over. So what we did is we looked at the situation of those 2 banks. And Silicon Valley Bank sold a lot of securities at losses to fund some of the, outflows in deposits. And then they said, well, we're going to raise capital. In the meantime, bank stocks are, prices are falling tremendously. There was no way to replace their capital. So they realized the loss, and their capital ratios were simply too low. But we also looked at, how much in large deposits, like above the FDIC limit, did they have? Silicon Valley had about 90% of their deposits were well above, the FDIC limit of 250,000. Some of their deposits were in the billions, per customer. And what they did, they attracted a lot of venture capital. So small tech firms that did IPOs, raised money and went to Silicon Valley Bank as their bank. So, of course, they got nervous all at once, and, many people were recommending get your money out and all that. So we then, looked at our own deposit base, and we have about 14% of uninsured deposits, which is much, much less. And, that's a number that we, if all of them chose to withdraw at once, we would easily be able to cover that with our sources of cash, our sources of borrowing, and we would not have to sell securities at a loss. The regulators in the FDIC, they stepped in, they handled mergers for those banks. Some of the unique issues, they had such large percentages of those deposits above FDIC limits. And, it forced all of us to look at, our own deposits, our own ability to borrow, whether, we have enough cash on hand or, the borrowing ability. As an analyst, I'm looking at these numbers, for banks, as well as their capital levels. Silicon Valley and Signature Bank, once they did, took losses on their, investments, that they were selling, their capital ratios fell very low. So, our capital ratios are typically higher normally because we're a mutual, we don't have access to the outside market. So we tend to keep them much higher to begin with. So, we are insulated from that kind of impact. Um, I look at also, the earnings record. Those banks were earning pretty well until the end. But, what's their long-term record? What were they doing the past couple quarters? What are they projected to do? Are they still profitable? Are banks diversified enough? Like when you look at Silicon Valley Bank, they were not diversified in their deposit base. So much was these large, tech firms with their deposits. If you look at our deposit base, we are well diversified across retail and business. And we also have municipal deposits. So we have, a good mix. And, the business deposits, some of those are the larger amounts that I spoke of, above the limits. But those are successful companies in our area. And many of them came and discussed the situation with us. And, they were comfortable and, we still have the deposits. We did not have any kind of substantial deposit withdrawal. So, one other thing that you typically want to look at is, do the banks have a good loan portfolio? Is it diversified? Is it some business, some consumer, some residential mortgage? SVB Bank did not have much in the way of loans at all. They had a whole bunch of securities and they bought long-term ones. Do they have strong coverage for credit losses? What we do, we have a pretty strong process here to put a reserve for credit losses. So we look at that, we compare it to our peer banks in the area, so we are relatively strong in that regard. And, there's some fear that, banks will now, because of this crisis, tighten credit standards. Maybe raising the rate, maybe making, raising the criteria, for a business to borrow, just to be on the safe side. And that can lead to, the economy going down, or weakening over time from that. It also would prevent refinancing for some of the loans. It's CRE loans, they have a 5-year time period. Anything made in 2018 at really low rates is now going to reprice up, to the current level of rates, which are much higher. So, that could create some issues. And then finally, the Federal Reserve looks at the top banks. I think there's 23 of them. And they do periodic stress tests. And they say, well, would you be able to weather a storm where the economy sinks a lot, where unemployment shoots up from, the current 3 point something to 10? What if CRE prices are falling a lot and housing prices? So they run all that kind of thing. And they did find them all to be strong and they all passed. So that's some comfort that the industry is relatively strong.
Shifting gears, because you mentioned the Fed, and even in your response to the first question, kind of looking back on Q1 and Q2, we've spent so much time talking about the Fed, talking about the rate environment, their effort to combat inflation. You've shared your opinions on when you thought they should be pausing to allow for kind of the review of what's working or what's not. So at this point, can you just expand a little bit? I know you mentioned inflation rates kind of holding steady or even dropping a little bit. What's the Fed's current posture? What do you think that they might consider? And what are they looking for ultimately when it comes to an inflation number that they might feel comfortable going back to a more traditional, what we'll call a more traditional recent rate environment versus where we're at today?
Right. The first thing, the Fed had to raise interest rates in response to inflation. They had no choice because it's one of their jobs is to keep prices stable, and they were not. So prices were soaring. They had to raise rates. They also have to worry about unemployment, and that really hasn't moved that much. But, this recent cycle by the Fed has been one for the record books, raising rates so quickly. In just a little over a year, they went up 500 basis points. Now, if you look back to the beginning of 22, they said they would raise rates 3 times or 75 basis points. It lulled everyone into this, situation where, they're not, if rates go up 1%, that's not too bad. Well, here they're up 500 basis points. It's just, it is kind of outrageous. But they started in March of 22. And then, the last time they raised rates was in May. And they did 25 basis points again. The Fed funds rate is now 5.25. And keep that in mind when I go through some of the things, some of the inflation measures in a minute. But they did not change rates at the June meeting. But they did, I call it, threaten to raise rates 2 more times. Their projections came out as they normally do quarterly. And most of the committee members said we should raise rates another, 2 times 25. So they did threaten to do that in future meetings. But I think the truth is they don't know for sure. They're buying time to see, you mentioned going back and, assessing what you've done so far. I think they're buying time to see that, the cumulative effect. But, the reality is inflation is declining and it's taking pressure off of them. I watch a number of inflation indicators and they're all down, year over year. Give you some examples. CPI, the most recent one that came out was for the month of May. And that was up 4%. It was 9.1% June last year. So it's cut in half from that. The producer price index is even more dramatic. Year over year, it's up 1.1%, which is kind of incredible. The peak for that one was back in 22, and that was 11.7%.
Wow.
And that was indicative of, remember, all those supply chain issues and, goods were scarce and, everybody was bidding up the prices. So that, that tells me the supply chain appears to be okay now. Nobody's outbidding each other on that. Some of the Fed measures, they use something called PCE, personal consumption expenditure. And they do, it's a formula and it's a quarterly number. That number for the first quarter was 4.2%. And the high about a year ago was 7%. So that's down pretty dramatically too. And their favorite one, this is about the only one that hasn't come down a lot, the core PCE. And by core, they exclude food and energy prices. And that is currently 5%. So just under their, Fed funds rate. I think what they were trying to do is get that Fed funds rate above the inflation rate. And they probably focused on that because they do talk about that one a lot. There's one other one that I follow a lot. It's the employment cost index, and it's a quarterly number. The fourth quarter was the most recent one I have, was up 1% for the quarter. A year ago, it had been up 1.4. So that one is down also. The University of Michigan provides consumer sentiment type numbers. They also ask consumers in their survey what they think inflation's going to be. And in the long run, most consumers said about 3%. So that's down from 4, not 6 months ago. Mm-hmm. And if you look at what's built into the treasury market, the 10-year point, there's a normal treasury you can buy, just a standard one. And there's one that's indexed to inflation. So the difference between them should be an inflation expectation. Right now, that's 2.2. So that's not run away by any means. The Fed should be pretty happy with that.
Right.
And then the final thing I'll mention there is the money supply. The Fed's affecting the money supply constantly. That has been negative year over year since December. And it's the first time since 1960, when this series has been published, that it's been negative year over year. So my theory is if, money supply was runaway, high percentages in 2020 and 21. Now, if it's, that caused inflation. Now, if it's negative, that's going to pull inflation down naturally. So the Fed can rely on that. Because what they're doing, in addition to raising rates, they're also letting their portfolio run off and mature, and that's draining money out of the system.
Right.
So, that naturally is going to help bring things down. And then, moving forward, I mentioned I call it threatened. They've threatened us with 2 more rate hikes, totaling 50 basis points. I don't believe they're necessary because I mentioned the inflation rates. The Fed funds rate is already above that. So they could buy some time and just see it, sit and watch, make sure it's still on the downturn. But one thing about the Fed, I've experienced it over many, many years. They always go too far, whether they're raising rates or, taking them down. They probably went too far keeping them at zero for so long. Now, they're probably, too high right now.
You mentioned some of the indicators. Obviously, at the beginning, you always talk about the yield curve as one of those indicators. You mentioned some of them as they relate to inflation. We know job numbers can be an indicator. Specifically, looking at the strength of the economy, where are we at now? 2 years plus on from a pandemic, 3 years on from the onset of the pandemic. Are we in a strong economy, or should people be feeling that we're in a strong economy, or is it still not back to where it should be?
Well, I think we're sinking below where we were pre-pandemic. We were about 2.5% GDP growth, and we're down at 2 now, with projected in this quarter too. So, it's weakening somewhat, other than I mentioned the consumer. The consumer is still spending. Business investment is down, so they're kind of offsetting so that we have positive growth. But, if the consumer turns and, cuts back on spending, that's when we're going to start realizing, much weaker growth. But I think for now it's okay. But, if you look at some of the indicators, they are not that positive. They indicate recession, in the future. The main one I look at is, if you recall, the leading economic indicators. It's an index. And that projects what growth should look like 6 to 9 months from now. May was negative 0.7% and April was negative 0.6%. Now that's been negative for almost a year, pointing downward. So we are experiencing declining growth. Stock markets, they're another leading indicator. They would say, oh, things look okay right now. But, the S&P I mentioned was up 14%. NASDAQ's twice that because of, the craze on AI. And we're still down 8 to 14% from where we were at the end of 21. So we still have not fully recovered. We just have these bouts of, the market will rally, sell off, rally, but we haven't recovered any kind of highs. Corporate profits, this worries me a lot because in the first quarter, they were down 5.1%. And the fourth quarter, they were down 2%. The quarter before that was no change. So, we've now gone 3 quarters in a row with really no profits.
Right.
That's not a good sign. That tells me why they're cutting back on investment. But the possibility that they'll start cutting costs is, it's getting higher and higher. And, that could mean job loss. So, that worries me a little bit. Most of the business surveys out there, S&P does one, ISM, Institute of Supply Management, and then the Philly Fed and the New York Fed, they also do regional surveys. All of those are weak, mostly negative numbers. There's good news in them because prices paid are falling in those regional surveys, and the national ones too. So that's a good sign that inflation is coming down and the Fed can kind of stop. Now, you mentioned the inverted yield curve. That is becoming more inverted recently. There's 2 different points that I look at. The 10-year versus the 3-month treasury. Normally, the 10-year would be higher than the shorter rate. You're going to buy bonds long. You want some extra return. But that's not the case today. It's negative 156 basis points. And that became inverted in October of 22. The 10-year and the 2-year, that is currently negative 100 basis points. And that inverted initially in July of 22. Now, inverted curves, most people have a rule of thumb that they precede recessions by 12 to 18 months. and 16 months on average. So, if you look at the July of 22 one, that means the end of this year, pretty much. October, it buys us a little time, maybe early 24. But, on average, you would expect a recession. And they keep getting worse and worse. So it's not like it's suddenly improving and the outlook's better. It's worsening in my mind. Now, leading inflation, that continues to drop year over year. There's an index that comes out every month, and currently it's down 7% year over year in May. April was 7.6% down. So, every month we're experiencing a lower leading index, but the leading index looks at inflation, out 6 to 9 months, so it thinks it'll be lower yet. So that is a good sign for us, that the Fed can kind of stop and not raise rates anymore. And then I mentioned the money supply earlier. That is, tremendously, it was tremendously up during the pandemic, and now it's started to be a negative number. So we don't have any experience on that, but logic would tell us that, that's going to pull inflation down too.
So taking all of this into consideration, you mentioned recession and kind of the horizon for that, the indicators pointing towards that. I know some of the last times we've had you on, there's been a semantic, more academic discussion of what is a recession and do we meet the criteria. Looking out into quarter four, maybe Q1 of 2024, is the view that the indicators show a recession in the definition, in the commonly understood definition, or kind of the academic definition that was kind of debated at the beginning of this year and late last year?
Yeah, well, it's hard because we have one organization that declares recession. The classic definition used to be 2 quarters in a row of negative growth. We had that in 2022, the first and the second quarter, and then bounced right back. So, a lot of people attributed that to inventory building and, then they let it run down. So, who knows? But, technically, if you read your textbooks, we had one already. But, so I would look at that criteria, are we going to have negative growth in the future, for a series of quarters? But, there are signs, that the economy's weakening. GDP just came in lower than the fourth quarter. It's been, falling slightly each quarter as it comes out. Business confidence is down. And so consumer confidence is relatively low, although that could be volatile. The inverted yield curve, that's the one that's really telling me that, it's coming at some point. We only have time periods to work with, averages. I believe it will come soon. Based on that 16-month average. We're so far inverted that I can't see that, going back to normal soon. And what would make it go back to normal is the Fed cutting rates in response to recession. Then, it'll become a positive spread again, generally from the Fed cutting rates. The Fed's frustrated by the low unemployment numbers. You mentioned we had strong growth again in, April and May. Job payrolls were up above 300,000. So it's still relatively strong, but that doesn't give us any clue to the future. And I think May is probably seasonal hiring for the summer. So, I'm curious to see the June report. That could be strong again. And then you'll see September be really weak when the seasonal workers all go back to school or something. Sure. So it's impossible to know. But, we are seeing, the unemployment rate is very low. It's 3.7%. A year ago, it was like 3.5. So it's really hardly budged. And, we are seeing layoff announcements just about every day. I talked to my neighbor yesterday morning. He's just been laid off. Tomorrow's his last day. So, it's hitting people we know now. And then job openings, they're very volatile. They've gone up, they've gone down. But it seems like, everybody, companies still can't fill their positions. So they're keeping those jobs out there. There would typically, if we went into recession, there would typically be an increase in the unemployment rate of 0.5% to 1%. That's a general rule of thumb. You never know, but and that would be over, like, say, a 6-month period. But that could translate into 1 million jobs lost across our economy. So that would probably put us in recession, because the spending would have to go down for that. Consumer spending, it has continued at a modest pace in the second quarter. Retail sales were up in May. I think it was 0.3%, and personal spending was up 0.8%. That was an April number. I haven't seen the May one yet, but that was relatively strong too. I think consumers, my theory is, I think they'll spend over the summertime. They're going to go on vacation. They're going to enjoy themselves. And then come in, September, they're going to say, my God, what have we done? Look at our credit card balance. We're going to have to start paying that off more quickly. Some people are going to be impacted by the student loan payments starting up again. And I think that's August. It's relatively soon, but I think it starts in August. What they're going to do is have to make a payment again. But a lot of them are floating rates, and the rate's going to be a lot higher. So it could be a shock to a lot of people. I worry a little bit about that. And then, of course, the credit card balances. But, I think the best timing for recession, based on the inverted yield curve and the lead times, it's later this year or early 2024. The good news is that would cause inflation to fall. The Fed would cut rates, and they probably will have to cut rates a lot.
Looking at this, obviously, we tend to look domestically at a lot of these indicators, especially for decision making at the bank level. But for folks that are looking at hearing the word recession or talking about the market as a whole, can you give us any kind of insight on the international status of the economy? Is this a challenge that other major developed nations are dealing with? Is there fears of a global recession? What can we look to on a global scale?
Yeah, you are right. We are going to probably have a global recession, because major economies, they're all facing the same thing. The issues are inflation, and their central banks are also raising rates, dramatically for them, because rates were so low for so long, and the economies are getting weaker. This includes Europe, Japan, the UK. And there's indications that Europe's already in recession. I don't know that they've declared it yet, but a lot of people are saying that they're already having issues, with unemployment going up some. They're also highly dependent on importing oil and gas. So they're subject to the volatility of those prices. Inflation, I mentioned it's about 4% on the CPI here in the US. It's 8.7% in the UK, so twice ours, 6.1% in Europe, and 3.5% in Japan. So, everybody's facing an inflation issue. Now, China, I think they have their own set of issues. You don't hear much about inflation impacting them, but they're having, except maybe real estate prices, but they're having issues with production, shipping, maintaining their sales levels. And I think this is because a lot of major countries, including us, we're trying to build alternate supply chains because of such disruption that we experienced back in, it was mainly 2021. We weren't getting any product, it was just insane. We want to avoid those severe issues. And, some of the products that hurt the most were the semiconductors and the auto parts. It held up, production here in the US for months on end. It was just insane. But some manufacturing is coming back to our own country. But I think ourselves in Europe, we're looking to countries like India to maybe start up some production so we have an alternate source. And it wasn't lost on me that the Prime Minister of India was here visiting at the White House the other day. So I think that's probably what the discussions are. What kind of manufacturing can we set up, using their big population, So I think things like that are really hurting China, which leads me to believe China will have to start cutting their prices for people to, like undercutting prices. That could make inflation fall really quickly. So, who knows what's going to happen. Our dollar in the U.S. remains very strong. Those implying that those other countries have weak currencies. So part of the GDP report said that our exports were pretty strong because of the strong dollar. And the strong dollar keeps the price of their goods coming in, keeps it lower. So that helps inflation as well.
As we sit here today, I know we've kind of looked out at what the numbers are telling you, but as we sit here today, what are you kind of projecting out for quarter three as we look forward in the near term, and then as far out as December and into early next year? What should folks maybe be planning on, or at least looking to be up to date?
Yeah, I think, taking the third quarter, July and August, I think they'll be strong. And everybody enjoy your vacations, and September will be a little bit of a reckoning maybe, in the fall. But I mentioned earlier that, the inverted yield curve, that's telling me that, the end of this year, early 2024, we could be in recession. Now, how bad the recession is still in question. It may not be as bad as ones in the past. The worst ones were probably the early 90s and the early 80s going back. We had the pandemic recession. That was tremendously down and then tremendously up. It lasted like 2 quarters, but I'm not sure of the extent of how bad it would become. And then, the Fed can always lower rates to make it not as bad. So, we have tools to, keep that in check. But, the inverted yield curve is telling me that, it's coming at some point soon. But, consumer spending is holding us up right now. But corporate profits being negative, I think that's a bad sign for the future. As people make their plans, higher interest expense is weighing, it's weighing on companies, especially small business. They can't afford, I don't know how they can afford, higher costs of everything with inflation and higher rates, funding their businesses. And then consumers are facing the same thing. Credit cards are usually driven by short-term rates, so those are up as well. And not to mention mortgage rates are up. They're up 250 basis points from, 2 years ago. They're, 6.5% right now. They were, 4 2 years ago. They were 3 before that. So, it's a big change in people's budgets. But GDP has been weak. It is weakening. And, the high rates and high debt levels, the government piled on much more debt during the pandemic years. The debt ceiling compromise that we had back on June 3rd, that, the federal spending is supposed to be coming down to match prior year levels. So that will reduce growth a little bit, not having all that money flooding in. And then, I expect the fairly strong early third quarter. We could see slower growth in the fourth quarter, as businesses reassess, consumers possibly slow their spending. Bad news would be layoffs if they start to come, and higher unemployment. Good news would be falling inflation. Inflation has fallen in every recession we've ever had, so it will fall this time too. And then, maybe the Fed has to worry about negative inflation. Declining prices, that's, one of the worst things, that we can experience is deflation, because it takes the value of all assets down too, so that, I'm not projecting that scenario, but, that, who knows? But the Fed would start cutting rates, and I think, much more quickly than they would project. And then, most economists are projecting like a 60% chance of a mild or modest recession. And only about 25% of them are saying severe recession. Now that 25% is a little higher than normal. Usually most people would say 10% severe recession. So, it's twice that, but, based on the inverted yield curve and a couple of those leading indicators, most people would say that. So we'll have to see how this affects the economy. The markets will tell us what's happening. If rates start to plummet on the long end, the long-term rates, we know that they're building in recession, declining inflation, recessionary scenarios. We'll see how it plays out. I think the Fed probably should stop raising rates and assess the cumulative impact before they do anything else. And then one of the things that, I'm starting to think about in 2024, we're entering a major election year. So how will that impact how will politics impact everything? So it remains to be seen. It's always a challenge.
A lot of variables for sure to take into account. Dorothy, we appreciate you, looking in your crystal ball and giving us the projection for the near term and into the future. We always appreciate kind of reviewing some of these indicators and what's in the news. And hopefully folks can make an informed decision and stay up to date. And hopefully sign up to receive your newsletter so they get this great detailed information right to their inbox. So we'll include that in the notes for this show. But Dorothy, as always, thanks so much for joining us today. We look forward to having you on again.
Okay, thank you so much, Aaron. I appreciate it. And, have a great summer. Enjoy.
I hope you've enjoyed this episode of Mutual Growth, a podcast by Penn Community Bank. Be sure to subscribe and leave us a rating. And as always, keep up with the latest from Penn Community Bank by following us on Instagram, Facebook, and LinkedIn. For more information about this podcast, links to past episodes, or to learn more about Community First Banking, just visit penncommunitybank.com/podcast. Mutual Growth is the official podcast of Penn Community Bank, member FDIC, equal housing lender. It is produced for the benefit of current and prospective customers and partner organizations. This program is provided solely for educational and entertainment purposes. The information contained herein is based on sources believed to be reliable, but is not represented to be complete, and its accuracy is not guaranteed. The opinions, views, and estimates expressed are those of the presenters at the date of production and are subject to change without notice. Please email marketing@penncommunitybank.com regarding booking or repurposing any part of this podcast.